Today, guys, I want to talk about all the different ways you can use debt to make some money, and not in the ways you're typically used to hearing, like real estate or companies like Lending Loop, where you loan out all your money and hope it comes back one day. But let's jump right into this one. Welcome back, passive income investors alike. Today is a really interesting video I'm very excited to talk about because I don't like debt. I hate it. I have absolutely no debt in my life. I buy everything with cash, including my cars. If you're a Dave Ramsey fan, you'll be down kind of the same boat as the idea of debt-free. But I also don't like the ball and chain lifestyle. You know, that friend of yours that just got that really fancy suit and tie job, big raise, but meanwhile they just went out and bought a brand new Mercedes or BMW and they don't actually own it. And they're just putting a chain on themselves to their desk where they'll never move again because they'll have to work there for 5 or 10 years to pay the car and the mortgage off and all this crazy stuff. I don't like any of that. And when it comes to actually mortgaging out money in any way, because I'm sure you've heard, there's a smart way of leveraging debt, and that is with real estate. That's smart debt, as they call it, where you're just going to take out a huge mortgage and make money on that mortgage. That's why people like real estate so much. But I don't want to talk about that. Everyone else talks about that. You can learn that elsewhere. And I don't want to talk about Lending Loop and leveraging your money to 500 people in hopes that somebody pays you back one day. I'm sure you've heard of Lending Loop. They're online companies where you can privately mortgage your own money out to people. But the rate of returns on those in the long perspective of things I've heard is somewhere between 5 and 8%, not as high as 10 or 12%, kind of like they promote on the website. And you're also taking on very risky debt, and you don't know these people and you don't really know what they're doing with the money. You just get a rating from a bank or some kind of financial advisor that put a rating on the mortgage or the debt that they want, and then you kind of just fork it over and hope to God they don't default on it. So you're probably thinking to yourself then, well, what kind of debt am I talking about? What kind of good debt could there possibly be? Before I explain deeper into why I want to talk about this as well, let me just talk about the bank really quickly, guys. The bank will tell you the safest thing you can do, just put your money in a high interest savings account. You're lucky if you're getting 2% if you've met their premiums. And that 2%, guys, sits there. What's 2%? 10 grand, 2%, $200, whoop-de-doo, right? Like, it's not that big of a deal. Meanwhile, they're taking your money and they're leveraging out on the street to credit cards, people that own credit cards at 20 friggin' percent. My goodness, they're making one heck of a return. They're getting 18% while they pay you 2%. That sounds logical. But that's what banks do, guys. They leverage out loans. They want to make as much interest as possible, and they understand the default rates. But I want to get around the default rate. I don't like taking risk. I don't want to mortgage out debt into like buying a house, and if I don't understand anything about housing, I could be walking into a trap. I don't want to be going on Lending Loop and lending out all my money either, guys. So what do I do here? Well, recently I've been talking to some people that are very, very wealthy, and I'm trying to set up some meetings here because I found an interesting way to leverage debt in a way that's a lot safer than most people would think. Because usually when you think about handing somebody a loan, like a loan shark, when you hand somebody that money, you think that there's a chance they might not pay you back and you have to break some legs. Well, there's ways around this, guys, because it comes down to what they're using that money for. And instead of using companies like Lending Loop, if you privately approach banks, there's private investors that specifically deal with a bunch of different banks, and they look and scan through a ton of different investment ideas. So what I mean by this, and I really want to know your guys' opinion on this, and you can let me know in the comment section below because I haven't done this yet. It's something I'm thinking about doing in the next 2 years. Say you've saved up some money. Maybe you have 100 grand, 50 grand, whatever, and the bank is going to offer you a line of credit at, say, maybe 3 or 4%. Well, what would be wrong with, say, taking that line of credit, finding somebody that's maybe on a second mortgage, and they're trying to buy a house. Maybe they have a really good job, they're like a firefighter or something like that, and this is coming from personal appearance. I've seen this and how this works, guys, and I met the two sides of it, the people loaning the money and the people taking the money. So this is why this is really interesting me. But say you find that right person and you can make anywhere from 8 to 12% by giving somebody money that wants a house, or they want some kind of commercial real estate, or they want something that is a physical asset. So what you can do is you can analyze these people, guys, and you can get to actually meet them and know who they are and what they're trying to accomplish, and you could take out a line of credit and pool it together with some other people's money, and then they will give it to them on a private loan, which you can do through the banks, guys. And the cool thing about these kind of private mortgages that you can get involved with, if they default, unlike Lending Loop, unlike a lot of other companies, if they default on these loans, and you know if they default on that, you end up getting a percentage of that property anyways, because it's going to have to be liquidated and you're going to get your money back because it is what is owed. Obviously, after all the other vendors are paid, because usually that's how it works. Say the bank is the #1 loaner on a property and you threw some extra money in just to make something and it defaults. Well, the bank gets their money back first and then they pay out the rest of it to everyone else. Now, does this sound kind of confusing? Yes, absolutely. It's not the easiest thing to accomplish in the world because you need a good line of credit. You need to find some way to get debt. And I don't like mortgaging money. Every time I've looked at a way of taking debt and trying to mortgage it maybe into a property, well, I'm not comfortable enough to buy a house in Toronto or Canada here. It's way too expensive for me right now to even want to consider it, because it would take every dime I almost have in the bank to get a down payment on what, an $800,000 million home. A little crazy for me. I don't want to open up a margin account on a stock market portfolio, guys, because the banks can do a margin call. I don't know what's going to happen in the world. I have no idea. Companies can fail overnight. Things can happen. Things can take a turn for the worse, and all of a sudden your stock could be down 50% and the bank says, you know what? I don't want this to go down anymore because you have our money, so we want our money back. And they'll force you to sell out these positions. When they force you to sell them out, well, say you put 50 grand in the stock market on a margin account and it dropped 50%, the bank says, you know what, we want our money back. Well, the problem is you only have 25,000 now, so now you have to pull 25,000 out of your own pocket to make up the difference to get back to the bank. It's annoying, and it's something that I never want to run into because it's just a risk that you cannot foresee. Now, again, can you make a lot of money doing this? If you're willing to take the risk, for sure. But the only thing I've seen so far that works, bar none, the best, is mortgage money out to people that you know, businesses you see, houses you can feel, and things that have an actual backed up asset behind them, because you know they're going to have insurance in case something burns down. There's more security in this, guys, and it's something that I've been looking more and more into, because let's be real, if you can find someone on a second mortgage that's going to be paying 8 to 10% and you can get a line of credit for, let's just use 50,000 as a base number. It's probably a little high, it might be a little lower, but just to make numbers a little easier to understand here. If you can find an 8% mortgage and you have say a 3% line of credit, well, you're gonna have to be paying that 3% on that $50,000, but you're gonna be banking almost 5+%, guys, if you do this correctly. And 5% on 50 grand, you're gonna be bringing in an extra $2,500 a year on that 50,000, guys. We are not buying anything that can go 100% default. That's the rule here with mortgaging debt, in my opinion. Or if you're going to leverage debt out, you want to get it in a way, guys, where there's some sustainability to it, where no matter what, you can't lose all of it. That's the main game with this, and I think this is an avenue that really works. Now, if you go into any bank, you can tell them that you have money that you want to mortgage or leverage out, and they may be able to help you with that. But I want to try and find a way to use debt, because I just know some people, personally, I'm not going to mention any names, but I know some very wealthy people that own multi-million-dollar properties that they pretty much have them mostly leveraged out there. Buying a house to me is a good way to passive income, but it's not seamless. Like, there's a lot of setup involved. If you want to lose out on some money, you're gonna have to get somebody to manage those properties, and the only way it's 100% passive income is if you don't have to do anything and the checks just come to you. The problem is when those checks come to you, you got to pay all those checks out, you got to manage everything, make sure everything's okay, house isn't burned down, insurance is paid for. All of this is a lot of managing involved, unless again you're willing to mitigate it to somebody else, which it's just a lot of work up front that I'm not willing to do right now. I don't know enough about properties to be comfortable even doing that at this stage in my life, but I'd be more comfortable doing this idea of leveraging out the bank's debt and level, guys, where you can try and find a way to make somewhere between 8 and 10% off of it. Sounds very appealing to me. It sounds a lot more safe. I feel a little bit better about that, and again, I'm not one of those people that's leveraging out everything I own. It would be a very small percentage of my portfolio, so if something bad did happen, it wouldn't be like detrimental, but at the same time it could be very beneficial to be able to make anywhere between an extra $2,000 and $3,000 a year off 50 grand. Does not sound like a lot to you guys, but I'm trying to think of base bottom here, like being really reasonable with my numbers. Let me know if you guys have ever thought about any of this stuff in the comments section below. I have done quite a few meetings at banks. Like I've said, I've talked to a lot of wealthy people, and I've talked to a lot of people on the other end of it that are taking out these mortgages, and I'm talking about people that are like firefighters, guys. I know people that have really good sustainable jobs that are taking out second mortgages and they're sustaining these loans. And again, if they default, well, the loaner ends up getting whatever the property sells for because it's going to get auctioned off or put back up on the market when that person defaults. I am talking very conservatively here, guys. The people I deal with can and they have made 12% of mortgaging money. So again, if you can make 12%, guys, on someone else's debt, it's a fascinating concept, and I don't think there's anything wrong with debt if it's used sufficiently. And this is so far the best way I've seen to use it sufficiently without having to put up a lot of effort in the beginning. It's just finding either somebody that can vet the people for you, or you personally going out and vetting it yourself. An interesting idea. Let me know what you think in the comment section below. Very interesting. It's just something very interesting that I've been looking into, and it is something I'm going to start taking advantage of. Maybe in the next 2 years. I'm going to wait until I build up my accounts a little more before I take on any more risk. Stay cool, stay awesome. Is this something you are doing? I want you to tell me in the comment section below. I would love to hear about this if you've ever leveraged debt out, even if you've been your own personal loan shark. I find it very fascinating, and I want to know other ways of utilizing debt, because now that I have a decent amount of capital, I mean, if I could find a way to use debt that I'd be able to get in a very smart and intelligent way with the least amount of risk as possible is what I'm going for, even if it makes me an extra 3 or 4%. So stay cool, stay awesome, guys. I'll see you tomorrow.